Welcome to PhillipFutures Market Watch. My name is Lee Zhenhui and I'm an investment analyst with PhillipFutures. As the Eurozone crisis heightened the risk aversion, many major equity indices declined, and the risk of further downside remained high due to a possible Greece exit and the Spanish banking crisis. This sell-off could provide an opportunity for bargain hunting. From a risk-reward perspective, we think that Chinese equity indices could outperform due to several reasons. Firstly, Chinese equity index is now cheap from a valuation perspective. The FTSE China A50 index is now trading at a lower trailing price-to-earning ratio and lower price-to-estimated earning ratio compared to how it was during the global financial crisis back at the end of 2008. When the price-to-estimated earning ratio of FTSE China A50 index is compared to other indices, the index is now trading at 22% lower than Asia excluding Japan and 33% lower than S&P 500. The cheap valuation could be pricing in the credit risk and housing bubble overhang. However, we see a controlled housing price deflation rather than a hard landing scenario. Hence, the balance of risk tilts towards the upside. Secondly, there is scope for monetary easing to support the economy. The slowdown in China's economy till now is associated with policy choice made by the Chinese government to curb inflation pressure and to deflate the housing bubble. With inflation easing to below China's target of 4%, this gives China leeway for monetary policy loosening to support the economy and ensure that the GDP target of 7.5% is achieved. In response to the recent slew of disappointing economic data, China has cut the reserve requirement ratio, RRR, in May by 50 basis points. 2 more RRR cuts are expected this year, and this could be supportive of the equity prices. In the event that the economy slows down even further, China still has other monetary policy tools at its disposal. For instance, China could cut a lending interest rate to prop up the economy. Lastly, Premier Wen Jiabao has recently urged for more policy support for growth through fiscal incentives. We are unlikely to see the same kind of fiscal stimulus that China resorted to during the global financial crisis because China is now able to tolerate lower growth as it rebalances the economy towards higher quality growth driven by private consumption. China certainly has ample fiscal flexibility to boost the economy, given the low government debt as a percentage of GDP. In line with the Ministry of Finance priorities, we are likely to see more fiscal expenditures channeled towards urbanization, transportation, rural projects, and initiatives to support small and medium-sized enterprises. Therefore, Chinese equities, which are trading at an attractive valuation, could remain supported by monetary and fiscal policies, despite uncertainties emanating from the Eurozone. Due to corporate governance risks that Chinese equities may be exposed to, investors could consider trading in the stock market index futures, such as FTSE China A50 index futures, because company-specific risks are diversified away. For more information on the risks and returns of investing in stock index futures, feel free to approach any representatives from PhillipFutures for further discussion. Thank you and stay tuned for more Market Watch videos.